Hello, this is Sergio Morero, and today we're here with our next guest, Yesenia Gallardo Avila, who is a principal at Occam Advisors. Thanks for joining us tonight, Yesenia.
Thanks for having me. I
Yeah,
appreciate it.
I was just sharing with the audience. I was saying to Yesenia that she is the first investor I've met that's named Yesenia, and I look forward to there being more. So thank you for joining us tonight and sharing a little bit more of your story. But for those that are just joining us, I'll share a little bit about Yesenia's background. So she is a graduate of Willamette University, also graduate, got her master's from Yale University, serial entrepreneur, and now at Occam Advisors, focused on impact investing. So excited to dive into not only impact investing but education, which I have a love-hate relationship with the pace of that industry, but we'll get into that. But Yesenia, if you can share with the audience, can you share a little bit more about Occam Advisors?
Yeah, thanks. My mom will appreciate the plug for Yesenia. It was a name that I hated when I was a child, but now I love it. And for those of you that are not familiar, it was a very popular soap opera in the 70s that just like took Mexico by storm. So that's why there's a lot of Yesenias around my age. Um, so a little bit about Occam Advisors. So this was a firm that my colleague Patrick founded 5 years ago. We're based in Portland, Oregon. I don't know if this is the investment hub of the nation, but here we are in Portland, repping for impact folks. So our firm works with a number of clients around the impact space. So we help them sometimes develop a program and then execute their impact vision. So we source, diligence, and manage investments on behalf of our clients. We have a number of clients, mostly philanthropic institutions, community foundations, and family offices. I specifically only work with one family office. So we're a little bit siloed in our business model of how we work with our clients because we work with them in such a collaborative and deep manner to help them kind of create their thesis, or if they have a thesis in mind already, then how to execute that. So the family office I work with is called Potencia Ventures, and they're active investors, both for funds. So we make a number of fund commitments and then also direct investments in emerging markets with a focus in Latin America, India, and the US. The US is a little bit more opportunistic for us in terms of investments, but we are pretty active both on funds and directs.
Amazing. And if you could share a little bit more about what size investments do you make and what do you look for? I know you have, since you're doing fund investments and direct, you can go start with either.
Yeah. We love talking to emerging managers. So if there's emerging managers that fit this criteria I'll talk about, we're happy to connect. So Potencia makes investments on the fund side, which is where most of the assets are managed. But the direct investments, as you probably know, take the most work. But on the fund side, we're actively looking for diverse managers in the US. I think the diversity conversation is a little bit different in emerging markets, but in the US, that's a big focus for us. Potencia is also looking for any, so our focus primarily is around education. So for us, that's funds that are like have a focus or a meaningful focus, potentially an exclusive thematic focus in education. And so that's companies, products that connect folks to either better educational outcomes or better career opportunities. So that can be anything from early childhood, K through 12, adult learning, future of work. Those are all sectors that are really interesting to us. So from a fund perspective, there does need to be some activity in that space. It doesn't have to be an exclusive focus, but that's a really big criteria for us. And then on the direct investment side, on that side, we're active in the seed to Series A stage. We tend to not be looking at pre-seed companies. We're happy to look at deals and lead them in Latin America for the most part. We're a little more opportunistic in the US where we invest alongside our managers. So we're mostly co-investors in the US. But in our emerging markets, we're looking at directs, again, seed to Series A in that same sector. So education, future of work. Happy to talk a little bit more in detail of some of the companies in our portfolio, but we've done tickets as small as 100,000 up to 2 million. So we have a lot of flexibility. Again, as a family office, it really is, we like to think of the role that patient capital can play, especially in this sector where sales cycles are long. It takes a long time to see improvements in folks' educational outcomes over a period of time. So that's something that we're really focused on as from an impact perspective.
Amazing. And as before we get into I mean, there's a lot of directions we could go. I'm looking forward to hearing more about your take on impact investing, and let's go there first. A lot of funds, or at least speaking with many LPs, impact means philanthropic at times. Is that changing right now? And if so, how is the term impact changing?
I think for a long time, the conversation was really focused on mostly concessionary capital. That's definitely not what we do. But what we can do is play different roles. So there's a couple of ways that we're thinking about it, maybe more creatively. For all of that is said and done in the investment world about innovation and creativity, there's very little innovation in terms of the financial instruments that we use. So, like, if you put some weird terms in a term sheet, it freaks everybody out. And so we're willing to take a couple of those risks. So we're really interested in things like revenue shares. This is especially useful and can be a really valuable tool in markets like Latin America, where there isn't maybe as developed venture ecosystems. Or we're also really excited just by companies that have the potential for strong but linear growth. It doesn't always have to be a hockey stick exit for us, because at the end of the day, we're really thinking about the impact. Is this a company that is going to be committed for the long term to markets that might take longer to penetrate, where potentially there's lower price points, but that also means greater accessibility and hopefully also a bigger market share? So a couple of examples of that where investors, and in the education space and especially in emerging markets, we're really interested in products and companies that are targeting public school students. It tends to be easier to go to private schools that are serving middle or upper classes. And for us, we're willing to be active board members to make sure that we're talking about what price point makes sense for impact. It's okay with us if it takes longer, recognizing that the path to real growth might take 3 to 5 years, because that's how long it'll take to get the right government contract, especially with like the politics of specific markets, with getting into these specific contracts negotiations that can take a really long time. And to us, that's really important. So these are ways that we think of sort of playing a role from the impact perspective. And again, with to sort of circle back, the different needs of what companies are looking for when it comes to capital they're different in these markets. And so we're open to different conversations about the timeline, the horizons for our returns. We're really open to different mechanisms. A 3x return for a company that has a lot of impact is really important. So I don't think of it as concessionary, but certainly we're talking about potentially different return profiles. We also think about it in terms of a balanced portfolio. So we have a number of assets under fund management, which we have different expectations for from a sort of market rate return. And when we think about our direct investments, we're willing to be a little bit slower on the time horizon, because I think overall, when we're looking at asset allocation as a whole, we're balancing those in different ways.
Amazing. So great clarification between the expectations of both. How are you measuring and defining impact, or expecting your emerging fund managers to measure and define impact for you guys, for you all?
Yeah, I think we're fairly unique in the way that we don't measure impact very in any particular. We're not looking for specific measurement. We don't use any tools, like we're not using like GIN or any SDGs. When we invest in a company, we talk to them about impact, and that gut check if a founder is truly committed to serving low income populations and whatever that outcome is for that population. I think you get a pretty good sense of that as an investor, and making sure that real commitment is there. We do track individually by company, but that looks different for every company. We don't make any requirements that they be reporting a specific metric to us. So for any given company, it could be how many users they have. If they already track things like student income or increase in income because it's already baked into whatever service or product they're offering, then we're happy to look at that. As a general rule, we are primarily focused on products that serve low-income populations, but there isn't a defined really parameter for us around that. With our funds, we are open to investing in funds that aren't explicit impact funds. So we have some that are more generalist, but we also think of their role in whatever ecosystem they're they're in as if they're ecosystem builders, so they're contributing to the venture landscape and like helping build up the access to capital or like accelerator programs, stuff like that, that might also spin out a fund, are really interesting and exciting to us. And so that's another way we think of impact, where they're not going to report on anything specific, but we know that they're, maybe it's a small fund that's like having 190, we have a fund that has 190 companies in its portfolio, and that impact in this region is really, really big. From access to capital perspective. So there's different ways that we think about it, but we don't have a specific measurement.
Excellent. We just spoke with the group about all the different ways impact measurement, from the SDGs to GIN to homegrown different measurements. So
Yeah,
thank
it's
you for that.
hard. I mean, we've also seen people, like, especially on the impact side, when they're maybe philanthropic institutions particularly, bake in a requirement to report into like a term sheet. And those things can get, I think, really tricky to have those conversations. So we like, to keep the focus on whatever it is the entrepreneur is doing, and like have those conversations, and we have them actively and have hard conversations, but we aren't going to necessarily bake them into any hard requirement.
So I have to, amazing insight from the LP perspective. If you can share, how did you end up focusing on this area, getting your master's from Yale? I'm sure you could have done a number of things. What has led you to focus particularly on impact and impact investing?
Yeah, I've had a sort of long, conflicted road to impact investing, or maybe not even that long. I think in my heart of hearts, I'm an entrepreneur. I'll go back to that. I don't know that venture will be my career for the rest of my life. I think when you have that sort of desire to build something, I think it'll always be there. So I always have just like a weird side hustle here and there. Always been like selling or flinging something. Right now I have a little venture that I started about 5 years ago, and it's really just a passion project, importing mezcal. For those of you that are familiar with the delicious spirit. So my family's from Oaxaca, Mexico, and we started this 5 years ago to support smallholder producers. Kind of this like frustration with the George Clooney's and the Breaking Bads of the world coming in and capturing all this value for this cultural product that has such value and resonance with folks from Mexico, especially in indigenous culture. So we drink a lot of mezcal in our house, which is really fun. So in terms of impact investing, I mean, as an entrepreneur, I've always wanted to sit on this side of the table. I think it's a valuable perspective that'll inform whatever it is I want to build in the future. And that's an incredible tool to have. And I think, there's a lot of paths to venture. I think impact is the one that fits most with my personal mission and values. I've always been really focused in my personal work to access to capital for underrepresented folks. As an underrepresented founder, that's always been key. And I think that conversation in the impact world is certainly turning more towards that. We see a lot more explicit and intentional conversations about diversity, both at the GP level, in terms of the founders that we're investing in. And those are conversations I want to be a part of. I can also be really critical of impact investing. I think you really have to ask yourself hard questions about its limits and be cognizant of what it can do and what it isn't meant to do. We're not changing the face of capitalism, or at least I don't think I am. I don't have any illusions that that's what we're doing. What I do think we're doing is finding really cool companies and supporting them to do some cool stuff. But I think that there's limits to it. And you have to ask yourself a lot of questions about where all of this philanthropic money does come from. And those can be really uncomfortable things to grapple with. And at the end of the day, you kind of make your peace with what you're doing and love it for what it is, but not going in but going into it, eyes wide open.
What was the coming out and you mentioned being an entrepreneur at heart. What can you talk about what made you shift from a few years ago from focusing on entrepreneurship to being at Occam Advisors?
Yeah, well, I started a couple of different ventures. My first one was a cricket farm. So I had a company that was very early in the edible insect space that was raising crickets, which is extremely hard to do. And we just didn't have a really well-rounded team. So I think, that was a good lesson learned. And that was my first attempt at building something. And we did that for about almost 4 years. And so taking a step back from that, I think it was kind of just being disillusioned and wanting to get paid in real money and not like, golden leprechaun coins at the end of the rainbow, having worked at many nonprofits and then running your own venture. That's also nice. So, taking a pause and figuring out what I wanted to do. And I think a lot of it really was driven by an interest in learning the sector and a genuine passion for representation. I've also met very few Latina women. There are, I think, a lot coming up, and it's so exciting to see like so many wonderful people coming in to these different firms and the firms that we're seeing build up the ecosystem. A big shout out to VC Familia and folks that are doing some really amazing stuff. But when it comes to folks that are at the decision-making table, it's still very, very small. And seeing Latina women of color, of indigenous background, super rare. And I think representation is so important. And that's something that I wanted to be a part of those conversations and be in that space.
Excellent. Yeah, we just had Cheryl on last week talking about VC Familia and
Right on.
And some of the community. Yeah, we all know each other and we keep crossing paths with this.
It's a small familia.
It is, which is great. It's a great. Look forward to it growing. As you look at impact investing, do you see it and with the focus on underrepresented investors and founders, do you see that sticking? Like in your honest assessment now, like do you see it sticking, and what can we do to help make it stick, not just be something temporary, a temporary focus?
Yeah, I hope so. And I think that there's so many things at stake, right? Like we have seen so many commitments go to GPs that are launching funds for the first time, that we're seeing in underrepresented managers, and that's so exciting. And then I want to see those commitments get even bigger. So right now it's easy to write a $250,000 check or even a $2 million check to a new emerging manager. But as these funds grow, and I hope they do, and that as they're successful, making those commitments, getting bigger checks, getting into the real sort of big money, whether it's like pensions or folks that are able to write larger checks, making sure that we're unlocking those doors, that's going to be a different conversation. And on the founder side, we also see so much money swirling around in the seed stage. Like there's a lot more, maybe not enough, but certainly more. And I think the conversation gets really different when folks are getting to a Series B or Series C. Those checks, I think, are fewer and harder to come by for founders of color. So making sure that they have access to that capital later is going to be really, really key. And I don't know how that will play out. I think that's a really important conversation. One of the other conversations that I think is maybe less robust in emerging markets is what that diversity or underrepresented founder conversation looks like. I think it's different from country to country, region to region, but certainly thinking about grassroots entrepreneurs, entrepreneurs that are from those specific regions, representing those regions and building companies. That's something I'd love to see more folks that are focused in emerging markets, especially the LATAM region, having more intentional conversations about. I don't think we're quite there yet.
And you mentioned LATAM, and in the US, well, I would say US investors moving to Miami, that's a different sort of shift. But also with SoftBank, going and focusing on Latin America. I was a founder out of Startup Chile and have seen that ecosystem take off a bit, and it's great to see. What do you see for Latin America, and what do we need to really help those founders and accelerate the startup space there?
Yeah. I think it's such an exciting time to be an investor in Latin America. I think everybody can feel it. And there's the rise of so many different fintechs. Fintechs has sort of taken kind of the forefront of the movement. And certainly the unicorns that are coming out of this space are predominantly from that sector. We're seeing so much, mobile penetration, et cetera. What I do think is sort of my own personal musings are that, well, there needs to be a lot more education, just on access to capital terms, venture, et cetera. But because it's in some ways maybe a newer landscape, it has yet to be, fully a finished portrait. There could be a lot more activity again around education about maybe not venture, anti-venture, or just whether it is, dividends or whether it's slower growth or whatever it is, which makes a lot more sense for these regions. I think where you're having potentially slower paced companies that are very like either brick and mortar, which is still, a lot of folks are still looking for brick and mortar services or products, where there's just a different need for the population. There might be different needs for capital. Certainly, there's a lot of need for like mezzanine debt to grow companies that are very like family held, which is still a huge way of doing business. There needs to be a conversation about what it looks like to have alternative structures besides venture, so that it doesn't become this huge rocket ship trajectory that everybody needs to get on when that doesn't necessarily fit the model, and instead have a lot more productive companies that can contribute to the ecosystem, and hopefully, especially in the impact space, where again, the unit economics are harder, and it is just a different model that's needed. So having conversations like this at this time would be incredible in Latin America. I mean, there's a lack of education around venture in general. So some things that are common to see in LATAM are really messy cap tables where somebody's raising a seed round and they only own 30% of their company. That's really not uncommon. So those conversations are one thing, and then having the conversation about what alternatives to capital might look like at an early stage, I think could be really beneficial for founders. When we talk about anything like a revenue share, it is like a totally different conversation in LATAM, even though we think it might be the best fit for the company, or just might, be an option for them to consider, because it's even more foreign than it might be here.
Yeah, excellent. And I think that the alternative investment space, having revenue share and taking on venture debt, is actually a great alternative for different businesses here that are growing at a slower pace than, like you said, you expect, right, venture capitalists to bring you the win, like the high growth tech startups, right? So having those different expectations with a different structure, I think that's definitely common. Do you see that? Now with, I feel like there's so much focus on early stage capital, also with crowdfunding. Do you see alternatives such as venture debt, really becoming more accessible for early stage founders, or do you see other vehicles forming?
Yeah, I think they are. And I think crowdfunding is a really exciting potential option, but not one I know a lot about. I do think that venture debt specifically could be something that really is valuable. Again, it takes just a lot of education. It's interesting to have conversations with founders and offer, something. I don't know like the exact what sort of a ballpark would be for venture debt, but when you're thinking about like dividends or some kind of self-liquidating instrument that's different, you're talking about at the low end 2, at the high end 5x returns, and that seems like such expensive money, and you're being kind of usurious. And that they might not be wrong, but venture is going to require 10x. At least that's what you're trying to underwrite for. Whatever the expectations at the end might be different, but it's interesting to have conversations like that when anything outside of venture is considered just too expensive. But the alternative, if it is venture, it seems astronomical from what you're giving away as well. So I think some kind of reasoning between the two is also really necessary.
Absolutely. I would love to shift to what you started with. You talked about education and your lens on the future of education. At this time, we've gone virtual. It's burdened our system. I myself teach at University of Chicago, and they cannot wait to go back in person, while I I think that's the historically where they've been. What do you think is here to stay in education, and what do you think is just just gonna change forever? Like what are some of those trends?
Yeah. Oh my goodness. There's so many things. We keep talking in our office about how for a long time it was like never very sexy or cool to be an education investor. It was like fintech or prop tech, and now it's like very cool. Well, it's cooler. But yeah, I mean, education has seen some pretty significant tailwinds over the last year, and plus in COVID, I think people have recognized that there needs to be more disruption in how we deliver education and the workforce. So future of work is something that we're really interested in equally, and how it impacts folks' ability to have for upward mobility, for improving their livelihoods, etc. So I think some things that we're really excited by in education. I'm really interested in education finance. I think we have had limited conversations about that. We see things like income share agreements, and I think we can be fairly critical of those. I think they've been sort of a mixed bag for folks. On the one hand, you can get access to education for free for now, and it allows folks to have a different career without a lot of upfront costs. But then folks are capturing a lot of value as folks, go into their careers, or in the worst case scenario, they now have these crazy contracts over their heads for something that didn't really end up resulting in a whole lot. We've seen income share agreements also come into Latin America. There's every single week, there's a new coding bootcamp that I hear about. And so, I think that it's a different market, so we have different expectations for what that could look like. So I guess I'm a limited fan of income share agreements, but I do think that the financing needs to be a conversation. So some kind of blended model where some of the costs could either be put on future employers, and partly on the person that's looking to upskill. I think those are really interesting mechanisms, or potentially like secondary markets for these kinds of funding, or the kind of debt that we're seeing come out of these places, I think could be interesting. And we also used to be really big fans of blended education. We were always really big believers that the greatest impact would be when you were in person to some extent, but certainly the scalability for a product and the affordability comes with being able to deliver something in mass. So we always liked blended approaches. And that actually was proven a little bit wrong in COVID. So being investors in a blended education model wasn't the best, having had a lot of our companies quickly needed to pivot to 100% online. But I am seeing, that you can really have a really quality product that's 100% online. We've even seen it be successful in some companies with children, with like early childhood. And I think that's a really hard market to crack, to have a 5 to 10-year-old be engaged and really learning and building a passion for learning at that age is really critical. It tends to be something that needs to be very like sort of fun, I guess, to be obvious, but we've seen kind of different outschool type models where it's like you're taking classes on Zoom, but it's like learning chemistry through Dungeons and Dragons or something like that. So having a really focus on the child creativity side is really interesting. I think the other thing that we're excited about and have been for a while, and is especially needed during COVID, is early childhood intervention. So like you have a lot of parents who are isolated, parents who need a lot of support, or just are trying to figure out how to be a parent. And early childhood, so like infant to 3 or 4, like that's a really incredibly critical time for a child's brain development, emotional development. And there's not a lot of resources that are accessible to folks at scale and at a price point that's affordable. That's something that we're really interested in. And in Latin America, I haven't actually seen very many models. I would love to see something that's really, really scalable. We see it in the US where folks can download 1 million apps on the App Store for pregnancy, for infants, et cetera, but really penetrating access for low income folks for those kinds of products, I think is really, really hard, especially in these markets where there's still a lot of challenges around how expensive data can be, or just having internet access. And then $4.99 a month isn't accessible in Latin America. So the unit economics need to be different.
No, that's great to hear. I feel like there is, as you're saying, there'll be a shift, right? The old players will try to go back to the traditional ecosystems, and there'll be a gap in the market of those that want to truly provide a completely digital experience. There's now time for that. As you're thinking about Latin America, and I think in the US, there's a major problem of debt, higher education debt. The government is talking about some sort of relief, but that still doesn't solve the core of the problem, right? If they're still compiling debt for future generations, like what do you think needs to change systemically in order to really alleviate that going forward?
Yeah, I mean it's a huge piece. Certainly, relief is going to be a really critical component of that. Seeing the expansion of debt forgiveness, I think, could also be really creative. I know I've had like a couple of really preliminary conversations with folks in our region. Senator Ron Wyden leads a lot of great efforts for tax reform, et cetera. And he's had conversations with folks here in Oregon about maybe debt relief for entrepreneurship because it's generally for folks that are in nonprofit spaces or I think that could be a really interesting way to like spur more folks to take the risk of being an entrepreneur, which is incredibly stressful and takes a lot of grit to do. um, so there's potential room at the sort of the legislative level. Certainly interest rates are ridiculous for folks that are borrowing. um, and then I think the other piece is just, I think, recognizing or having really just honest discussions about what the value is of education. I think we're really excited by a lot of higher education products that are shorter, more bite-sized, more digestible, more affordable, and usually fairly like niche, so very focused on, this is a 5-month MBA or et cetera, and having a really quality product that can give you the certificate or the whatever it is that might give you a potential edge up, I think will be really disruptive. We've already seen that. And having those pieces and then having the employer side, I think the conversation that's often lacking is you can take a lot of these programs in adult learning or higher education programs that are remote, but if employers are unwilling to recognize them or unwilling to give them value, then it doesn't translate into positive outcomes for the folks that are spending time and money to take these courses. So having, a real national conversation about what employers are looking for and what they're willing to take, and having that conversation shift to employers, not just the institutions of higher education, I think will be really valuable, and making sure that those are actually creating some kind of benefit for the folks that are using them.
Excellent. Yeah, look forward to seeing more innovation, especially in that space. Online education is not new, but slow to be adopted at those levels. Um, it, to I wanted to shift back and say I think we're just at about time. Yesenia, just wanted to thank you for some of your sharing your story and also insight on the emerging manager and LP front. So thanks again for joining us. And for everyone watching, this was Rebel One Live. Please tune in to see more amazing VCs and CEOs like Yesenia. So thanks for joining us tonight, Yesenia.
Thanks.